Hi there, dear investors. My name is Thorsten. I'm the founder of Dividend Stocks Cash. It's about stock analysis, trying to find stocks which are promising to help you benefit from growing dividends and capital gains. This time it's about, you might guess it, Realty Income. Realty Income, very popular REIT. I read in Facebook and on other social media that many people would like not to have invested in REITs. They have enough of REITs because many REITs were badly touched by the effects of the Corona crisis. But REIT is not always the same. There are different kind of REITs. There are REITs in tourism, which were very badly hurt. REITs in retail mostly, like Realty Income, which are very badly hurt. But there are also other REITs which even profit from the effects of the Corona pandemic, like American Tower or Digital Realty Trust, for example. We talk about Realty Income. If the stock, in my point of view, is a buy, if dividends are safe, if the stock is fairly valued because the stock price compared to some months ago, before the outbreak of the Corona pandemic, the stock price dropped. We will see all this, and there's also an analysis on our blog about Realty Income. I will post a link below. We will do a lot of fundamentals, especially the valuation of the stock and my opinion. This is an analysis of Stefan Radlich, an author of Seeking Alpha also. And as I said, I will link this. I will refer a little bit to this analysis as well. For example, let's talk a little bit about Realty Income. Retail REIT, building and operating commercial sites, centers around the United States, a little bit in Great Britain, for example, also. And if I remember well, Puerto Rico, we will see this very soon. So who are the tenants? It's not the small shop owner, but it's big chains like Walgreens, 7-Eleven from Japan, Dollar General with very cheap stuff, FedEx and so on. So it's the big names who themselves are very often companies you can invest in as a shareholder, even like Walgreens, 7-Eleven, Dollar General. These are all stocks you can buy if you want. And now the question is, in general, they have a very good standing, but now the question is, are they touched badly by the outbreak of the Corona crisis? We will see in a very short time. Here you see the different sectors of the customers of Realty Income. If I say it's a retail REIT, it shouldn't be a surprise that most of the customers are coming from the retail customers, some industrial and a little bit office and even less agriculture. So retail is responsible for about nearly 85% of the total rent. And then you see a little bit more within the retail industry, the sub-segments. And there are some segments where this is important because some sub-segments are more touched from the coronavirus like others, and we will see this very soon. Here are the different states Realty Income is present, and especially the rental revenue. The rental revenue, in which states they make most of the rentals, so like this. And you see that Texas, Florida, and the South Belt, California too. These are the states, the second wave of the Corona crisis, which is just ongoing in the United States. These are the states which are hit the hardest, and that's bad sign or bad outlook for Realty Income right now, because these core states for Realty Income are hit rather hard, and there is the probability that even if there are no lockdowns, forced closures of the retail stores, that people are staying at home or shopping online rather than shopping in the retail centers of Realty Income. So that's not so promising. Then we have some more figures, and that's interesting too, because here you see which subsegments are negatively affected by the corona outbreak. Realty Income publishes once a month now the rent collections, and this is the latest I know from June. We now have the start of July, 11th of July, and here we see that theaters are touched very hard. So there's about 0 rent collections. Then health and fitness, of course, are also negatively affected very hard. But for the rest, it's still more or less okay. But we have, for example, 2 days ago, the biggest tenant, Walgreens, published a press release with very bad figures. So the longer the corona outbreak is ongoing in the States, the harder it will be in generally spoken, for Realty Income to maintain the dividends. We will see it in a very short time. Okay, then we start here with the fundamental analysis, and we will do this live. We are here on Dividend Stocks Cash, and I will just start the screener. We have more than 60 different REITs covered here. So the largest REITs from the United States should be all available here for analysis. We can just filter by the industry group, it's called here, and then we have all these REITs, and here we have the industry. So REIT is not a REIT, but it always matters what they rent. I already said that, for example, Digital Realty Trust is not badly hurt by the corona outbreak. You can see it if you have a look at the price change of the last 6 months. Then you see that there are a lot of losers, especially here in the retail sector, tourism, lodging, healthcare also, but a lot of losers in the retail industry. And if you just change the sorting, then we see that we have some winners also. It's tower REITs like SBA Communication, American Tower, Crown Castle. These are tower REITs. And then we have the data center REITs. Digital Realty Trust, Equinix, I think, is also data center. Yes, these are the winners. And some industrial, and also these self-storage REITs also didn't lose so much. But for example, retail and lodging REITs, tourism REITs were hit very hard. And now we analyze a retail REIT. So let's change let's select the losers, and then we just need to go a little bit down to find Realty Income. I could also find by symbol, but here they are, Realty Income. Not the stock did not lose as much as many other stocks in the retail industry. Other stocks lost much more, 22% within the last 6 months. Capital losses is not so bad for a retail REIT. So just to give you some numbers, let's stay here, or just reselect the line, and you see it's a monthly dividend payer. You probably already knew it's a monthly income company. It's also a name of Realty Income. Nearly 5% dividend yield. It's even a dividend aristocrat with 25 years of dividend increase. And if you look at the funds from operations, then you see that we have a very stable growth of the funds from operations, and on a parallel, the dividends were increased as well due to, thanks to increasing funds from operations. And here you see that the earnings per share, the reported earnings per share, are not very important because dividends completely ignore these. So you should always ignore these and prefer the funds from operations in the case of REITs, but you probably already know all that. which is also interesting, is that the number of shares is growing, not decreasing. So no share repurchases in the retail industry mostly. This dilutes the earnings per share, but most of the time the organic earnings per share growth is larger than the earnings per share dilution due to capital increases, because REITs need to spend 90% of their net taxable income on dividends. They don't have enough money to grow by themselves, but they need to make either debts or capital increases to finance their growth. And you see this here. That's financing by capital increase. If you look at the total debt, then you see financing by debts. They also increase their debt level and now have 8.7 billion in debt. They have cash, not very much if you compare this, just 50 million, 55 million, but they have credits, they can, or loans, they can base, or they can increase their debt volume if they want. Stefan wrote something about this on the analysis. So we shouldn't worry that Realty Income will fill or will go bankrupt very soon. That's not the case. Before something like this would ever happen, they will cut the dividends. And I think dividends are very interesting. Who is going to buy the stock if he's not interested in dividends? I think nearly no one. So we'll look at the dividend turbo to get an idea if the current dividend yield is rather high or low. Here you see the dividend ladder, and you see that here we have a very solid dividend payer so far. And dividends right now are about nearly 5%, which is rather high compared to some months ago. And analysts estimate that the dividends won't be cut, but continue to increase. We will see. If I look a little bit further into the past, then we see that the dividends are oscillating very much. They are on the low, just slightly above 3%, 3.3, 3.4%. On the top, about 5%, or even a little bit above. If we go back just long enough during the financial crisis, even 7%. And if we go back even further, then we see even double-digit dividend yield, 11%, but that's very far ago. So the dividend yield of Realty Income in the first decade of this millennium was higher than in the second decade of this millennium, or last 10 years, a little bit more simply spoken. Right now it's a decent dividend yield, but not extremely high. You can also see this if we add the 10-year corridor, then you see that the current dividend yield is more close to the average and not really on the top. It was on the top when the stock price was still below the current stock price, because the stock price recovered from the Corona outbreak. Get rid of this before. Let's have a look at the stock price, and then you see that in general there's a nice increase, a nice yield, or yes, a nice yield you could do with the stock if you own it for a long time. 11%, including dividends, without reinvesting. So that's already very nice, even on the current level of the stock price, which is $57. Stock price climbed as high as $82. Then we had this Corona caused drop, and still the annual yield in the very long run is above the average of the S&P 500. So that's good so far. But let's have a look at the current situation of the value, and especially of the valuation of the stock. And to do so, we will focus on the funds from operations. we'll focus on the dividends. We won't focus on the operating cash flow because it was a little bit bumpy here. And we could focus on the adjusted funds for operations, which are available starting from 2006. And they are mostly in line with the regular funds for operations except 2017, 2018. And then we have to choose the right time frame for the evaluation to calculate the multiples. And that's not so hard for the stock. I would really start here on 2006. And then we have, you can see the different multiples for each year now after zooming in a little bit. Yet you see that the stock got more expensive, Realty Income, starting in 2010. And here it was a little bit less expensive. So maybe we start the evaluation here, and you will see that here the multiples jumped or went a little bit, or the multiples are a little bit higher now than just before. So we agree that Realty Income might be valued a little bit more expensive with these multiples now. Okay, then let's get rid of all this, and now it's getting interesting. We have the stock price, and now we show the fair values we just determined. Here it's an operating cash flow. Now get rid of that fair value dividend. And then we see that basically we have periods of over and undervaluation. And Realty Income is a stock which is rather simple to evaluate. You see that all fair values are very close to each other. It's very simple so far to evaluate because the earnings or funds operations in this case are very reliable. So some stagnation or sometimes a little bit the funds operations are declining, but in general the evolution is very stable, which means that the fair values are rather reliable and stable as well. More stable are even the fair values based on the adjusted earnings. So get rid of this one, and then we have still this too. And then you see we have these phases of overvaluation in 2013, 2016 for several years, and now the latest phase of overvaluation till the outbreak of the Corona crisis, where the stock was clearly overvalued. And let's zoom in a little bit more, and then we have this Corona crash here, which hit the stock rather hard, about 40% capital losses within a very short time frame in March, starting in March exactly. And now the stock recovered. You see it here, the stock recovered, and now we are a little bit in the phase of undervaluation still. It recovered until the fair value, then it bounced back. Now stock price is $57 and the fair value is about 61 US dollar. So it looks like the stock is undervalued if you just look at this valuation, at this point of view. You could also, but we have high uncertainty about the future, and the uncertainty is much higher than in normal periods. We had these challenges of online shopping from Amazon and others, which were mastered rather well by the management, I think. I guess this might have been a slump in the stock price due to skepticism about the outlook of brick and mortar retail here. You can say that Mr. Market was pessimistic here. Stock price dropped, and then he changed his mind back and thought, oh, it's not so bad as I thought. Stock price recovered, not only recovered, but heavily got into heavily overvalued territory, and then we had this Corona crisis, and we all went back into negative territory here. And now we are here, as I already said. And the big difference between all these phases is that we have an extremely high uncertainty about what's going to happen right now. First, because of possible lockdowns. Second, because of changed consumer behavior. No one knows about how the corona crisis shapes the future consumer behavior. In other words, if shopping in real life and not in the internet will continue as it did just before the corona crisis came. We don't know, but we know that we have a high uncertainty here, and we know that we have only a rather slight undervaluation regarding the stock price of about 7 to 8%. That's a slight undervaluation only. So in my point of view, and I agree with what Stefan said in his analysis here, I think that the current undervaluation hasn't priced in the very high risk. So I could try to price in the current risk. I say PE of 90, close to 90 is not enough. At least I want to see a PE of 15, and here maybe even just of 40.5. And if we do so, you see that the fair value of the stock could also increase the dividend I want maybe to 5.5%, and then you see that the fair value based on dividends will be much lower, and then we have fair values between 47 and 50 US dollar. And from this point of view, trying to price in the high uncertainty, then the stock looks overvalued, still more than 10%, about 30%. So to conclude, I think that this Realty Income in general is a very solid company with mostly solid tenants, but some of them were already hit very hard, and we have a high uncertainty. The stock price doesn't reflect that, in my point of view. I wouldn't recommend buying Realty Income right now. Just better wait and see what happens, especially regarding the second corona wave we unfortunately see in the United States. So you just read this analysis. Stefan goes a little bit more in detail about the situation of the REIT, what's the REIT doing, and he gives his opinion, but which is mostly identical to mine regarding the fundamental analysis. Okay, that was Thorsten from Dividend Stock Sketch. Thanks for watching, and if you have an opinion about Realty Income, don't hesitate, just write it down. I will thank you, and others probably also. Bye.